Canadian investors holding bank stocks should watch Scotiabank closely after its earnings beat, as the valuation reset could create a TFSA entry point if support holds near recent lows. This is Modern Investing Techniques, episode 139. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. If you missed a few days, here is the short version of the week we just finished. Canadian bank names stayed in the conversation after earnings season. Professional money kept rotating toward AI infrastructure rather than just the usual public mega caps. And the valuation screen before entry remained the filter that saved us from chasing heat. None of those threads closed. The rate path at the Federal Reserve and the Bank of Canada still sits underneath every one of them, and that is the backdrop we are carrying into Monday. The S&P 500 closed at 7,786, down 0.2%. The NASDAQ Composite finished at 26,729, down 0.3%, and the TSX Composite slipped to 36,730, down 0.1%. I do not have a fresh year-to-date print for the NASDAQ in today's data, so I will not invent one. We will score the simulated book against the index on the matched window figures we do have when we get to the scoreboard. Tech shares did the weighing. Sentiment is cautious ahead of the next Fed decision, where markets have priced in a high probability of a September cut, while the Bank of Canada stays on hold with its next announcement due in early September. That pairing still leaves the open question we have been tracking: timing and size of the next moves, and how rate-sensitive sectors reprice when those dates actually arrive. Financials and industrials took the leadership shift this week as earnings season largely wrapped. Remember, we covered EPD 22 days ago as a dividend compounding midstream entry with second-half momentum. It closed down 1.45%, underscoring that even stated catalysts require volume confirmation to deliver. For a TFSA sitting in Canadian financials, today's tape is not a panic. It is a reminder that rotation into banks can fade fast if the September cut gets pushed, so position size matters more than the headline beat. Gavin Baker's second quarter 13F filing shows a clean pattern. Rotate out of high multiple growth names and into a mix of private AI infrastructure plus selective public tech and industrial ads. The strategy has a name worth stealing: catalyst layering. You take a fundamental thesis, in this case AI power and data center demand, then you overlay options on a liquid public name to amplify upside while you trim the positions that have already run hard. New positions tell you where the conviction sits. SpaceX came in at 27,332,943 shares, valued at $4,670.1 million. Cerebras Systems showed 3,110,086 shares plus 700,000 call contracts, a combined $842 million. Meta Platforms was 402,770 shares plus 1,200,000 call contracts, $902.8 million. The fully exited book is just as useful. Lumentum was a prior $187.9 million. EchoStar $117.1 million. Zoom Communications $105.8 million. Biggest adds reached CoreWeave, up 1,314,310 shares, and Wix, up 808,044 shares. Today's tape of concentrated tech leadership and softening breadth is exactly why this matters. Professional capital is hedging concentration risk without abandoning the AI theme, which also moves the open question we have been carrying on whether AI capex momentum persists or starts to unwind. Baker's answer, at least in this filing, is to stay in the theme through infrastructure and options rather than through the high multiple names that already ran. If you want to try a retail version inside a TFSA or an RRSP, you are not buying SpaceX. You screen on Questrade or Interactive Brokers using 13F data feeds for the public second-order names, then you layer modest call exposure only after volume confirms above the 20-day average. This approach has historically worked best in the early to mid stages of a capex cycle, when those second-order beneficiaries still trade at reasonable multiples. The main risk is overpaying for illiquid private exposure you cannot actually access, or mistiming the trim on the public holdings you can. One-line version you can repeat. Layer the catalyst, do not marry the winner. Our simulated weekly hold this week is BNS.TO, Bank of Nova Scotia, on the TSX, in financials. This is a simulated trade for learning purposes. No real money, $1,000 notional, Monday through Friday window. The catalyst is a second quarter earnings beat that put the stock's valuation back in focus after prior compression. We are not treating the beat as an automatic buy. We are treating it as the start of the analysis. Technical setup on the daily chart is price action near recent support, with volume needing to confirm any rebound. The level to watch is a move above the 50-day moving average. Risk is straightforward. Further sector rotation away from banks if rate cut timing disappoints. Stop loss sits 6% below entry, so the maximum simulated loss is defined before we click anything. Target is plus 3% to plus 6% over the weekly window if support holds and the rotation into financials continues. Confidence is medium. The earnings beat is a clear fundamental anchor, but broader rate uncertainty is the second variable that keeps this from a high rating. Two past lessons shape this pick. The memory chip hold used a valuation screen on names already discounted versus the broader tech complex, and that discount is what let the position hold up when momentum rotated. We are applying the same valuation discipline filter here instead of chasing the beat itself. The other lesson is the confirmation rule we wrote after that trade. Require closing price confirmation before declaring any catalyst trade complete. An earnings print is not confirmation. A close above the 50-day on volume above the 20-day average would be. You see a Canadian bank beat estimates, the multiple looks reset, and your stop is 6% down. Do you enter Monday's open, or do you wait for that close above the 50-day? I wait for the close. The first cheap thrill of a beat has cost this book more than the first patient fill. What you watch through Friday is simple. Volume versus the 20-day average, distance to the 50-day moving average, and whether financials keep attracting the rotation or hand it back to tech into the Fed date. Last weekly hold was MU, framed as a valuation screen on memory chip names. Actual hold ran 6 calendar days of market data, Friday through Thursday. Simulated entry was $903.60 at Friday's open. Exit was $949.83 at Thursday's close. The position gained 5.12%, or $51.16 on the $1,000 notional. Over that same window, the NASDAQ moved lower, so the hold produced positive matched window alpha, a win against the benchmark, not just a green number. The thesis held. Memory chip names were already discounted relative to the broader tech complex, so when momentum rotated, the position did not have to give back a premium it had never paid. What this teaches is narrow and useful. A valuation screen is not a vibe. It is a relative multiple check that has to be true before the catalyst, or the catalyst just buys you a falling knife with a better story. And we do not call the trade complete on the print. We call it complete on the close. That is now a standing rule on this desk. If you want to run catalyst layering or a post-earnings valuation screen without staring at a terminal, two tools are doing real work right now. Interactive Broker's TWS API lets you pull real-time options chains and 13F-style institutional data straight into custom scripts. If you already keep a margin account, you can automate alerts on volume spikes above the 20-day average without paying for a third-party feed. It is built for people comfortable writing simple Python queries who trade more than a handful of names a month. I have no financial relationship with Interactive Brokers. I mention it because the API is how you actually replicate a Baker-style overlay without a research staff. Wealth Simple Trade now supports price and percentage alerts on any TSX or NYSE name inside a TFSA. That is the low-friction version for a busy professional who wants the BNS.TO earnings setup on their phone instead of on a second monitor. Set the alert at the 50-day moving average and at a 6% drawdown from your intended entry. If neither fires, you did not need to look. I have no financial relationship with Wealthsimple either. Jane Street booked a $15 billion loss in its first down month in a decade. Even a sophisticated market-making book can gap when positioning assumptions break, so trim any single-name options exposure in a TFSA if it sits above 5% of the account until broader volatility calms down. South Korea proposed formal talks to end the war with North Korea. A diplomatic thaw could ease regional risk premiums that have supported certain defense and energy names. Add a small emerging markets ETF only after the 50-day moving average on the TSX Venture Index turns higher, not on the headline. 48% of U.S. employers have dropped pre-employment marijuana screening, which expands the labor pool for some industrial and logistics operators. Watch for upward revisions in 2027 guidance from Canadian industrial names with U.S. exposure before adding anything to a TFSA. Saputo agreed to sell its UK dairy operations, a divestiture that simplifies the balance sheet and could free capital for higher return markets. Hold existing shares through the expected first quarter 2027 close, but do not add until the transaction gets final regulatory sign-off. Simulated book, $1,000 per trade. 50 total trades at a 56% win rate produced plus $333.39 in cumulative P&L. Matched window alpha versus the NASDAQ stands at plus 9.3% across 45 benchmarked trades. The sum of per-trade alpha totals plus 13.4%, with an average return per trade of plus 0.67%. Best trade delivered plus 20.11%. Worst finished at minus 11.80%. And the current streak is one win. The book is learning to respect discounted multiples and to wait for the close. Those two habits are doing more work than any single ticker. Now, here is something most retail investors get wrong, and it cost me real friction before I mapped it properly. Imagine you just decided to add a Canadian bank stock to your TFSA after an earnings beat. Your order fills at the posted price. The actual cost of that fill depends on which brokerage you used and how its fee structure and market access interact with the ticket. Wealthsimple Trade is commission-free on Canadian and US stocks with a clean mobile app, but it limits advanced order types and has no margin. That is the right box for a simple buy and hold TFSA investor who rarely needs US options or real-time level 2 data. Questrade charges low commissions, gives free ETF purchases, and offers solid margin rates. That fits the active Canadian investor who wants occasional US exposure without paying up per trade. Interactive Brokers has the lowest margin rates and the broadest international access, but the platform complexity will overwhelm anyone who only needs basic TFSA execution. Bank-owned desks like TD Direct or RBC Direct plug into your checking account and then charge you for the privilege with higher commissions and weaker mobile tools. The pro tip most people skip is mechanical. Check whether the brokerage passes through exchange fees on US trades, and check whether it supports automatic dividend reinvestment inside registered accounts. Those two lines on the fee schedule move more money over a decade than the advertised commission. The misconception to kill is that the free platform is always cheapest. Wider spreads and missing order types force you to a second venue for a single ticket, and that second ticket is where the free trade becomes the expensive one. If bns.to is on your shortlist this week, pick the venue first. A 6% stop and a 3 to 6% target do not survive a sloppy fill plus an exchange fee surprise. Listener challenge for the week. Open your platform, pull up bns.to, and note the distance from the current price to the 50-day moving average. If that gap is less than 4%, add the name to a shortlist for potential entry on any volume spike above the 20-day average. Before we wrap, tomorrow I want to see whether bns.to can put in that closing price confirmation above the 50-day, because without it, the earnings beat is just a headline. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. This show comes to you from the NARA Network. If you want another sharp daily briefing, Planetarian Daily has you covered. Daily breakthroughs in science, health, and longevity. All our shows are free at naranetwork.com. Live dashboards, TSLA, SpaceX launches, the investing scoreboard are all at naranetwork.com data. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't